When I started in the business 20 years ago, one of the biggest benefits of becoming a homeowner was some of the tax benefits that you would receive. With previous administrations increasing the standard deduction and interest rates at record lows the last couple of years, we have had the tax benefit potential kind of fall by the wayside. But recently, with the rise in interest rates, we're starting to see more opportunities for clients to potentially itemize on their taxes. So, starting with a disclaimer, this is an oversimplified calculation to simulate a concept, not an actual result. You're going to want to talk to your CPA or your accountant and have them update numbers for your specific information. The example I'm about to share to you is assuming that it's a W-2 borrower under the age of 65, and we're not going to take into account any state income tax consequences. And this is going to be your primary residence only home, and there's no charitable deductions, which could affect the deductibility. So we're going to take a hypothetical purchase price of $1.2 million with 20% down. That's going to leave a loan amount at $960,000. And with interest rates about 7.5% today, that would leave a monthly payment of $67.12 per month, estimated taxes of $1,050 per month, estimated insurance at $5,400, which is all in, you'd have a monthly payment of about $8,212. So a couple assumptions here is this person buying this $1.2 million house would have a $900,000 income. And currently the standard deduction is a $27,700 for a married filing jointly couple. If we were to switch this over to a single person, the standard deduction is half of that. And we'll go back and forth between these two to show the difference. So assuming this person is single, their total tax income liability would be roughly $288,000 before itemizing. And so when we take into effect the property tax adjustment, which is capped at $10,000, and the interest on the first $750,000, there's about $56,000 there and $10,000 here, giving the client potential deductibility of $66,000 of interest expense and property taxes to itemize in their taxes. So what does that mean? It means that at the end of the day, they have potential to save about $19,000 on their income tax for next year. And on a monthly basis, that equates to about $1,600 a month. So on an after-tax basis, the payment is closer to $6,600, and the effective interest rate went from 7.5% to just under 5% because of the tax benefits. So a lot of our clients are saying when rates get back to 6% or 5%, that's where we're going to make the move. If you're in a high income earning bracket, you might already be there on an after-tax basis. So there's two ways to play this. One is to just go forward, make the payment, and then when you file your taxes next year, you would get a potential tax refund back. The alternative is for you to look at this amount here, maybe round it down a little bit, and then go to HR or your payroll administrator and change your withholdings so that more of your paycheck stays with you throughout the year. And then there would not be the tax refund, but there'd be more money in your bank account every paycheck. So hopefully this is helpful. If you have any questions, just let me know. Thanks.